Good afternoon. Good afternoon. Welcome to another edition of Monday Market Fix. It's the 13th of July, and my name is Silan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, there's renewed tensions in the Middle East with heightened concerns around oil prices and rekindled inflation fears as well, with both the US and Iran trading attacks. And earning season is about to begin as well. So July is going to be a pretty choppy month for all of us. So how should we think about regional strategy? Now, with the Straits of Hormuz open again, closed again, open again, how is that going to impact the second half ASEAN strategy? We have Anand Padmakanthan, our regional head of research and strategist, to answer those questions. And then we go on to the ASEAN telcos as well as internet. With softer macro conditions, what does that mean for the second half? We have Husseini joining us to discuss this as well. And then we've just completed Maybank's flagship Invest ASEAN conference last week, and we had quite a few large corporates, including two heavyweights from the Singapore living sector, Coliwoo and Centurion, presenting. We have Eric joining us to talk us through what he's heard, along with another investor favorite, iFast. We have the latest there as well. Plus, new chart from our chart guy. So quite a lot to go through, but let's start with Husseini first, with ASEAN TMT. Husseini, welcome to the show. Now, macro conditions have softened regionally. How will this impact the internet sector in the second half?
Yeah, sure. Thanks, Alan, for having me. The impact won't be uniform in our view. So we actually think that within the internet space, e-commerce should outperform on demand, which is mobility, ride hailing, as well as delivery services, given the softer macro environment. And the reason is simple. When consumers tighten their wallets, they don't stop shopping. They become more value conscious. They look for lower prices, vouchers, and free shipping, which favors platforms like Shopee. And in fact, we did a survey in 2025 wherein ASEAN consumers showed that necessities now account for a meaningful proportion of online purchases, while price and convenience remains the top reasons for shopping online. Now, in contrast, mobility and food delivery are relatively more discretionary spending. Consumers can reduce ride frequency, switch to public transport, or cook at home, and the higher fuel prices also fits into that. That's why we expect Grab's mobility growth to moderate to the mid to high teens versus 20% last year. And go to the Indonesian player, we expect their GMV growth to likely remain at low single digit levels. The other encouraging development is that competition on the e-commerce space has also become much more rational. So both Shopee and TikTok Shop have raised seller commission rates and focused on profitability rather than market share gains, which should support margins across the industry.
Understand. Now, when you take all that together, what are your preferred plays right now for the rest of the year?
So in the internet space, our preferred internet name remains C Limited. So for C, their e-commerce platform, which is Shopee, we expect GMV growth to be north of 25% in 2026. And as I said, that competition is becoming more rational, and the company benefits from multiple engines or earnings engines, including the gaming platform Garena, as well as the fintech platform Money. We also think investors underestimate C's AI optionality, given its unique gaming, commerce, and fintech data sets. On valuation, C trades at around 12 times FY27 EV to EBITDA. and means the growth is phenomenal over there, obviously. And that 12 times EV to EBITDA is around 20 to 30% discount to its peers like Mercado Libre and Coupang. For Grab, we remain positive, but have trimmed our target price and earnings by around 3% to reflect slower on-demand growth and a more cautious mobility outlook. The long-term story for Grab also remains intact, but near-term growth is likely to moderate in our view.
Got it. So top preference is C versus Grab. Now let's move on to the telcos. How is competition evolving in this space, and what are you expecting for the second half?
Yeah, sure. So see, the biggest means obviously the softer macro is a concern.
Mhm.
And during softer macros, if we look in the history, then we had seen some instances or episodes of competitive escalation. But unlike the previous cycles, we see this time around the competition remains remarkably disciplined. Our discussions with management teams across ASEAN suggest that operators are prioritizing pricing discipline, customer quality, and profitability over market share. This is to an extent is also driven by factors like consolidation in various markets. So maybe outside of Singapore, we have seen consolidation in almost all the markets, which is leading to this competitive discipline. Singapore competition remains elevated, but we are of the view that consolidation is a question of when, it is not about if. Now, supporting this, competitive rationality is moderating capex, as most operators have moved beyond peak 5G investments, and also we see attractive dividends of around 5 to 6%, which provides downside support. So our expectations for 2H is that a continuation of stable cash flows, resilient dividends, and disciplined competition, making telecom one of the region's most defensive sectors, even with macro softness.
Understand. Now, what are your preferred plays
Yeah.
right now?
Yeah, that's a very important question, more important question. So see, Tilan, the revenue resiliency and defensive cash flows, dividends, uh, in our view, provide downside support. That alone unlikely will lead to drive outperformance. So for Alpha, we continue to favor operators with identifiable re-rating catalysts. And in that context, we like Singtel for its AI infrastructure story through sovereign AI, GPU as a service, as well as continued capital recycling. Outside of Singapore, we like Globe Telecom in Philippines. Globe Telecom is looking to IPO Gcash, which is almost maybe 50% of the value of the company. The valuation they are looking for Gcash is somewhere around 10 to 11 billion dollars USD. Then Excel Smart in Indonesia and TrueCorp in Thailand. Both these names are beneficiaries of network integration. So both these companies drive network consolidation in those markets, and now they are reaping the benefits of the network integration and those synergies. And finally, one name to also highlight is Indosat in Indonesia, where Indosat, like Intel, is also driving GPU as a service and AI neo cloud, and that's one of the area where we are monitoring that stock as a potential AI play as well.
Got it. Thanks, Hussaini, for that. Now let's move on to regional strategy with Anand. Anand, welcome to the show. Now, Straits of Hormuz is closed again. It was open last week. We don't know where it's going to be next week. But despite this open again, closed again situation, you highlight that ASEAN is relatively unscathed from the Gulf shocks. Why is that?
Yeah. Hey, good morning, Dylan. Good morning, everyone. Yeah, straight situation is kind of funny, but tragic at the same time. It's a bit like Schrodinger's cat, alive and dead in the same moment. So I don't know whether it's open or closed. I don't think anyone does at this point in time. But I think when you look at the data coming out of ASEAN in terms of the impact of the Gulf War since February, it has been actually quite muted, compared to the initial, panic scenarios. When you look at our macro forecasts for the ASEAN 6, it's only been adjusted down very slightly, from 4.8% growth this year to 4.7%, and a similar slight decline in growth quantum for 2027. What's helped ASEAN? We are through this period of geopolitical volatility, energy prices spiking, and supply disruptions. Two things have really helped. One is the fact that we've been experiencing a huge AI boom. Yeah, so if you look at the manufacturing data coming out, or the export data coming out of many of the ASEAN 6 countries, especially Singapore, Malaysia, Vietnam, Thailand, the bigger manufacturing-based countries, it's been very positive. It's been exceeding expectations, and that's really lifted growth prospects for regional economies. And the other thing that's been helping is rising FDI. So, whatever the Gulf turmoil is causing, it is not disrupting a key thematic or multi-year thematic for ASEAN, which is supply chain relocation. So that you're still seeing record FDI numbers. You're seeing good DDI, or domestic direct investment numbers as well, helped by things like infrastructure development. I mean, Singapore is a classic example of that, but also in countries like Malaysia and Vietnam as well. So we've had all these offsetting sort of supports that have helped us through the Gulf turmoil. And now, we're seeing energy prices coming off despite the last few days. So we seem to be over the worst of it, I guess.
Okay, that's good to hear. Now, I mean, so that kind of brings me to my second question on, what are some of the big drivers that'll actually power the second half for ASEAN? And also, if you can give us a little bit of a peek into 2027, what are you seeing?
Yeah, I think even before the peace deal in June, investors were already gravitating away from Gulf-related news flow to make their decisions or their investment decisions, to refocus on domestic drivers. And that's the more mundane bottom-up stuff which we're used to, like macro GDP numbers, inflation numbers, as well as at the corporate level, corporate earnings. Post first quarter reporting, what are the guidance events coming out of Malaysian or regional corporates. So I think that will be the driver for the second half of this year, a refocus on domestic developments, especially on policy and corporate issues. I think some thematics that we should continue to monitor in terms of impacting share prices in ASEAN. One is the investment upcycle. So you think things like data centers, energy security, a lot of spillover into listed companies, construction, property, and other supply chain companies. Also, FDI inflows, as I mentioned before, remaining very strong. AI supply chain, very important.
Sorry, I don't understand.
Sorry, my phone is acting up. Yeah, AI supply chain issues as well. So I think those AI supply chain drivers impact a lot of stocks in the tech sector, especially in Singapore and Malaysia. So that's a key thematic for us. Equity market reforms, SGS, ex-NASDAQ bridge, what's going to happen next there. IPOs coming out of the Philippines. I think Hussaini touched on one before, Gcash. Very interesting. More new economy stocks coming into the ASEAN sphere. And also tourism, seeing a big recovery in tourism. So all those are the kind of thematics I'd look for in the second half. Against that backdrop, Dylan, I think for the next 6 to 9 months, we are overweight countries like Malaysia and Singapore. Increasingly optimistic on Vietnam, although that's still in our neutral territory for now. We are neutral countries like Thailand and Indonesia, and underweight the Philippines.
Okay. So look more at home. I think that's a good way to look at it, because there's way too much noise around the region and globally. So now you said you're overweight on Malaysia and Singapore. Very quickly, what are some of your key thoughts there? What makes them overweights? And
Yeah, I think
what
the
are your
most
picks?
Sure. I think the country that has seen the most things go right, despite the Gulf issues, is Singapore, actually. I think Singapore has been an active beneficiary in many ways of redirected capital flows, especially portfolio capital flows, investment flows, safe haven flows. So there's been a flood of liquidity into Singapore, and that's always good for asset prices, as you've seen the market perform very well as well. So I think that safe haven stability premium will continue to serve Singapore well over the next 6 to 9 months, especially given the last few days have shown a lasting solution to the Gulf is still elusive. But the macro backdrop for Singapore as well is very, very interesting for us. GDP growth has been upgraded many times, but you're seeing a confluence of drivers, infrastructure, multiple huge infrastructure projects happening at the same time. Capital management by the big cap firms in Singapore, which are lifting yields and lifting ROEs, and also AI deployment. Yeah, not just benefiting from AI manufacturing, but Singapore corporates, especially banks, some of the big caps like Singtel, actively deploying AI to improve efficiencies. So very good combination, I think. So Singapore, I think, will be a key driver. Some of the stocks we like there, financials like OCBC, also SGX on our buy list. A lot of AI supply chain related picks, Singtel, CSE, AEM, Franken are there as well. And Smiths have been a big outperformance sort of segment for the Singapore market, helped by the EQDP, etc. So stocks like restructured Olam is on our buy list. Also defense play, add value. Malaysia, I think it's sort of more of the same, executing on announced blueprints for key sectors like energy and semiconductor, and as well as continue to be attractive to FDI so that investment upcycle continues. Kind of stocks we like there are a bit more varied, a bit more sort of old economy, some energy security plays like Tenaga, SolarVest, also consumer staples, which we feel are quite well positioned to benefit from reduced inflation expectations. Nestle, Malaysia, Mr. DIY as well, and some tech plays. We recently upgraded the tech sector in Malaysia as more and more companies are feeling the lift from AI capex. So stocks like Vitrox, Pentamaster, MN Holdings, and Keeming.
Got it. Now, I just want to touch on Indonesia as well. Now, this is the market that has seen significant pressure from multiple fronts, from sovereign rating downgrades to index downgrades and so on. You still have the market as a neutral. Why is that? And also, are there any really bargain stocks right now that we should be looking at?
Yeah, Indonesia is a tough case, I must say, right now for investors, given the string of policy issues we've seen in the last 6 months, the added pressure from ratings agencies like S&P, also MSCI as well, is coming down hard on the stock market as well. So I think it's a bit of a perfect storm for Indonesia, but we would say that a lot of it appears to be in the price. If you look at the forward PER for the market, it is below 8 times PE. Yeah, it's as cheap as it's been for a long time. So any good news, any sense that perhaps foreigners are becoming a bit more confident from 1 or 2 policy catalysts from the government, or maybe Danantara, the sovereign wealth fund, is able to secure foreign investor buy-in to some of its bigger investment initiatives, that could lead to quite a strong bounce off these very discounted levels. So that's why we're still neutral despite the string of bad news. I think if you want to buy something in Indonesia, you have a very narrow sort of focus, deeply discounted blue chips, because they'll be the first to bounce anyway if foreign interest comes back to the country. So I think some names we like, BBCA in the banking sector, Kalbe Pharma in the healthcare sort of consumer sector, Mitra Keluarga in healthcare. That's quite a good sort of secular growth area, very defensive as well. And if you want to go down back to basics, cement company like Indo Cement, it's trading at like 4 times EV EBITDA, extremely cheap. That would be something we'd be interested in as well.
Got it. Anand, thanks for joining us. You can see more of his top picks as well as the overall country profiles with a lot more detail in our newsletter today. Now, let's move on to the Singapore living sector. We had managements of 2 of the biggest names there presenting at the Maybank Invest ASEAN conference last week. So, Eric, now before we go into company specifics, what were some of your general feedback and observations on the sector during the conference, especially in terms of investor interest?
Hi, Dylan. So based on our interaction with clients, most of them are generally positive about Singapore living sector. The key takeaway are visible earnings outlook given the robust capacity expansion pipeline. And some companies are also actively looking at potential MAAs or JVs, especially in overseas market, to accelerate their organic growth. And thirdly, the companies are also continue their capital recycling strategy to unlock value from their stabilized asset. But on the flip side, we see some downside risks that include uncertain macroeconomic or geopolitical conditions, which may lead to reduced lodging demands, as well as increased competition from existing or new players and changes in the government regulatory landscape.
Okay, let's go down a little bit more specific. Very quickly for Coliwoo, what are some of the key takeaways?
Okay, so given its high average occupancy rate of over 90% across portfolio, management is pretty confident of reaching its target of 10,000 rooms in Singapore by 2030. And going forward, it plans to prioritize its asset-light expansion strategy via master lease agreement and management contract. But that said, Coliwoo will also look to supplement its earnings growth through selective acquisition, either in Singapore or other developed markets. In addition, the anticipated sales and leaseback of its 7 freehold assets will allow the group to redeploy capital into other higher yielding opportunities that offer strong mispricing or repositioning upside. So this initiative will further strengthen Coliwoo's balance sheet and enables the group to commit to paying out at least 40% of core profits as dividends.
Understand. And then how about Centurion?
Okay, for Centurion, management is expecting a stronger second half of FY26 following its completed acquisition of a key workers' accommodation asset in Western Australia. The recent purchase of a 25% stake in a 182-bed student projects located in Perth is also part of the group broader capital recycling strategy to support its next phase of growth. We estimate that the portfolio capacities will increase from 81,000 beds currently to about close to 86,000 beds by 2027, supported by its robust development pipeline. And looking ahead, Centurion will also focus on expanding its revenue across multiple streams, including enlarging its own and operated assets, as well as growing recurring fee income from management service as its 38% owned Centurion Accommodation REIT AUM continue to expand.
Great. Thanks, Eric. Now, before I forget, this Saturday, 18th of July, is when we have our second half market outlook for Singapore, Engineering the Future. Hagbin and I will be there talking about what we are going to be seeing, and as well as our top stock picks as well. Plus, we will have 3 CEOs from very strong, high conviction stocks as well, presenting their stories as well. And you will have an opportunity to ask them questions. And there's also prizes and lunch as well. So if you haven't signed up yet, please do sign up. Seats are limited. Now, I just also want to quickly highlight iFast, where we saw quite a lot of investor interest during Invest ASEAN as well. Zuan House released the note, but let me take you through some very key takeaways. Ahead of the first half results, which will be out on the 24th of July, we are quite positive on the stock. The group, especially on the group's ability to scale through organic growth and strong operating leverage. The Hong Kong EMPF project has moved from onboarding into full operations. With all trustees now onboarded, margins should begin recovering from FY27 as implementation related headcount normalizes. While the first ORSO trustee is expected to add 3 billion Sing dollars in assets under management by the second half of this year. iFast Global Bank is becoming the next major growth engine. Management is positioning the bank as a wealth-first digital platform for mass affluent global clients, with its Ant International cross-border QR partnership providing a template for further collaborations. Now, long-term growth target remains ambitious but still intact. Assets under administration was up 27% year on year to 32 billion Sing dollars in the first quarter, supported by 1.25 billion of net inflows. And management continues to target $100 billion of AUA by 2030. So earnings outlook remains strong, supported by rising platform scale and a richer revenue mix. We forecast core profits to grow at about 27% this year and 22% next year, and margins also improving as well. And we have a conviction buy on this stock. Quick look at the chart guide. We've got two trading buys for Hong Kong Land as well as China Sunshine Chemical Holdings. You can see more details in our newsletter today. With that, unfortunately, we're out of time. Hopefully, I'll see as many of you on Saturday. Have a good trading week, and we will see you next week.